The next type of finance institutions are finance companies. So what distinguishes finance companies from banks, savings institutions, and credit unions is that finance companies do not take deposits. So we are moving further and further away from bank. If you look at bank as our primary form of financial intermediaries, then savings institution is still very similar, but they have different forms of ownership. And then credit unions are, again, very similar, but they're much smaller and they're regulated by different agencies. Finance companies is further distinguished from banks in that their primary purpose is to make loans. But the source of fund, meaning where they get their money from to make loans, is typically not deposits. So in order for them to, so finance companies typically fill a niche that banks and savings institutions and credit unions do not, are not able to fulfill. They are the largest provider of financing to consumers for retails. So stock credit cards, so if you take a Macy's credit card or a Kohl's credit card, those credit cards which you can only use to make purchases in the respective stores. Those cards are typically provided by a finance company. They are also very heavily involved in car loans. So finance companies, they range from a traditional finance company like GMAC, which is one of the largest car loan providers in the nation, to more questionable finance companies that participate in the pay here, buy here type of used car loans. So that's another very important market segment for finance companies. They also, some of them also provide real estate loans. So one important thing that, important characteristic of finance company is that they seldom deal with the borrowers directly. So if you take out a loan from a bank, for example, you'll walk into a bank and you'll take out a loan, apply for a loan. With finance company, you seldom deal with them directly, and you may or may not recognize their name. So if you want to purchase, say, a set of curtains from Macy's, or buy a mattress from Macy's, you will go to Macy's and you'll sign up for a Macy's credit card. You are working with a Macy's employee, and you take out a credit card in, that you thought you're dealing with Macy's, but actually you're signing a contract with a finance company that provides the funds through Macy's. The same thing for taking out a car loan. You go to a car store, an automobile store, to buy a car, and at the time when you're ready to buy the car, you sign the paper for a car loan. You're working with the car dealers, even though the money comes from a finance company. Similarly, for real estate loans, you will go to a mortgage broker. When you're buying a house, you find a house, your real estate broker will introduce you to a mortgage broker, and you work with the mortgage broker to find a loan. The loan that the mortgage broker sells you comes from a finance company, but you never work with the finance company directly. You're always working through an retail establishment. So a finance company, you can think of them as the back office, or the backside of a retail institution. They also work with business directly. This is a big part of finance companies. They do business loans and leasing. So you can see a similarity in there again with business leasing. A business will get an equipment through an equipment store, and the financing will be done through a finance company. For business loan, they seldom do direct loans, but what they typically do is either inventory loans, accounts receivable loans, and also particularly in credit card processing. So instead of when a business opens a credit card, they are actually getting a loan from a finance company, and the And then when the credit card company receive payment from their credit card holder, then the credit card company pays off the finance companies. So that's, again, those are the back office. You, as a consumer, you will seldom see a finance company, or you will seldom interact with a finance company directly. So since finance company typically operates in the background, they don't take deposits. Their primary source of fund is loans from banks or by issuing their own commercial paper and bonds. That's really their major source of financing. So finance companies are very highly leveraged. They issue a lot of commercial papers and bonds. When we talk about liquidity, finance company is really critical. Short-term liquidity is critical for their survival.